I didn't always trade with the kind of confidence that allowed me to consistently align myself with the market's probabilities. For years, the market exposed every weakness in my mindset. I believed I was smarter than the movement, smarter than the collective behavior, and smarter than the unfolding probabilities in front of me. But the market doesn't care about what you believe. It only reflects your relationship with risk, uncertainty, and your own internal conflicts. And that's what today's talk is really about. How I finally reached a place where I could flow with the market so well that winning became a natural byproduct. If you watched the previous video on the rule that helps you catch big moves, then you already understand why this next step is essential. Because catching the big move is one thing. Operating with the proper mindset inside that move is something entirely different. When I was a young trader, I craved stimulation. I wanted to feel involved. So I jumped in and out of positions just to feel engaged with the market. Every flick on the tape looked like an opportunity because I didn't yet understand the psychological cost of randomness. But let me ask you something. Have you noticed how the urge to take action often pushes you into trades with no real edge? That's exactly what it did to me. I was active but not aligned. I was interacting with uncertainty emotionally instead of probabilistically. Reaching the point where I could consistently win didn't come from being right more often. It came from learning how to handle being wrong without resisting it. When a trade invalidated itself, I accepted the information instantly. No bargaining, no denial, no emotional negotiation, just out. Because hope is the most dangerous illusion a trader can cling to. I remember a period where nothing worked. I couldn't make sense of anything. Every chart looked confusing. I'd enter too early, exit too late, and then watch the market move exactly as I originally anticipated, but only after I'd abandoned the position. You ever been there? It's infuriating. It makes you question everything. Your method, your timing, your experience. But that's when I learned a critical truth. The market doesn't test your technical skills. It tests the beliefs that shape your behavior. The turning point came when I stopped imposing expectations on the market and began aligning myself with what it was communicating. Prices express the collective beliefs of every participant. They hint before they reveal. Accumulation, distribution, conviction, hesitation. It's all there if you can observe without projecting your fears and hopes. And once you learn to see objectively, trading stops being a guessing game and becomes a matter of reading behavior. Behavioral interpretation, my friend, is everything. You can give two traders the same chart, and one will see threat while the other sees potential. Why? Because one is trading from fear and the other is trading from clarity. I trained myself to see without emotional distortion. Trend structure, volume behavior, context, flow. These became my framework. But don't confuse patience with paralysis. When the market presents a high probability situation, you must take the trade without hesitation. As I've said before, the big money comes from waiting for the edge, but it's kept by acting decisively once that edge appears. So I waited for setups so clean, so consistent with my rules, that they practically demanded execution. I didn't need endless opportunities, just a handful of high-quality ones. And when I got them, I pressed the advantage. That's another reason I started winning more consistently. When the market confirmed my edge, I allowed the probability to play out fully. I scaled into winning positions. I let the market tell me when the belief structure behind the move was shifting. You ever notice how difficult it is to simply let a profitable trade unfold? The mind wants certainty. It wants to lock in gains before uncertainty returns. But in trading, The fear of losing what you have destroys the potential of what the trade could become. Now you might be asking, how do you know when the market's about to shift? The truth is, you don't know. You recognize when the psychological environment reflected in price begins to change. The same setups that once carried momentum begin to stall. Volume behavior shifts from supportive to indifferent. It's like listening to familiar music. After a while, you immediately notice when something feels off. And that's when I tighten risk, reduce size, and prepare for the evolving probability landscape. Remember in that previous video, the one about catching the big swings, I told you that you must stay aligned with the trend until the probabilistic structure breaks. What I'm sharing now is how to live inside the trend without sabotaging yourself. The big swings reward those who can remain psychologically balanced, but the real professionals know when to add and when to defend. That's what separates temporary luck from sustainable consistency. I also stopped measuring progress in dollars. Strange, isn't it? But once I focused on executing my edge instead of measuring the outcomes improved naturally. My job wasn't to make money, it was to express my edge without interference. The market pays you for disciplined interaction with uncertainty, not for desire or effort. And every destructive habit, averaging down, revenge trading, holding losers, was nothing more than emotional conditioning I had to unlearn. I began treating every trade like a probability-based business decision. Would you invest in a failing store just because you're emotionally attached? Of course not. Yet most traders do exactly that with losing trades, hoping instead of acting. The moment I began treating losses as business expenses, necessary costs of participating in a probabilistic environment, I found psychological peace. And peace creates clarity. Winning consistently isn't about perfect predictions. It's about stacking probabilities in your favor. Each component, trend behavior, volume consistency, entry precision, risk placement, adds to your statistical edge. Stack enough edges together and the odds tilt your way. Break them even once and the structure collapses. And that's why discipline outweighs brilliance. And let me tell you something else. Trading doesn't just grow your account, it grows your identity. You learn patience because the market requires it. You learn humility because certainty is an illusion. You learn courage because opportunity rarely appears when you feel comfortable. The market teaches you to think in probabilities rather than absolutes. Risk first, outcome second. And once you think that way, you stop gambling and start trading. Every consistently successful trader I've known had one shared trait. They respected the market's neutrality. They didn't try to force outcomes. They aligned with what was possible. Because once you truly understand crowd behavior, you can step outside of it. You stop following noise, chasing headlines, or arguing with price. Price reflects beliefs, and beliefs don't bend for individual opinions. If you really want to reach the point where you're winning consistently, start by mastering the internal environment. The market doesn't defeat you. Your untrained responses to uncertainty do. Control those and the rest follows. Every time I followed my rules instead of my impulses, I gained traction. Every time I broke them, I paid emotional tuition. You ever notice how expensive the market makes the lessons when you think you've mastered it? The market humbles every ego that approaches it without awareness. So I learned to wait for alignment, act with conviction, and exit without emotional resistance. When you do that long enough, you realize trading isn't about predicting the future. It's about surviving and performing in the present. Because survival gives you endless opportunities to align with the next big move. Execution quality outweighs execution quantity. That's something traders understand only after years of pain. I used to believe that the more trades I took, the more chances I had to profit. But the market doesn't reward activity. It rewards mental precision. You can take 100 trades a week and still end up worse off if your mindset is misaligned. But one properly executed trade can compensate for an entire month of emotional noise. Watching the market day after day taught me something important. The difference between a losing trader and a profitable one is not trade frequency. It's mental clarity at the moment of execution. The market offers a few high-quality opportunities, but most traders miss them because they're too preoccupied with needing to trade. You ever catch yourself entering just because you haven't taken a trade in a while? That's not trading, that's emotional discomfort masquerading as opportunity. Execution begins long before entry. It starts with preparation, studying the environment, recognizing the psychological context, marking levels, defining risk, knowing your invalidation point. When you have a plan, you are no longer reacting, you're responding. And response is rooted in clarity, while reaction is rooted in fear. Good execution is calm, steady, and deliberate. No rush, no panic, no emotional spikes. You wait like a hunter who understands the value of patience. You don't act on shadows, only on well-defined probabilities. The moment you trade impulsively, you surrender your entire edge. And once the edge dissolves, every trade becomes a random outcome. I remember placing 10 to 15 trades a day thinking I was sharpening my skills. But when I reviewed them, the truth was obvious. Small wins, big losses, and no reliability. I wasn't executing a plan, I was executing impulsiveness. And the market charged me for every impulsive click. That's when I learned the real essence of trading. It's not about how often you act. It's about how precisely you act. Let me ask you something. Would you rather take one well-timed, high-probability shot or fire endlessly into uncertainty and hope something sticks? Most traders choose the latter. They act first and justify later. But every unjustified trade injects noise into your performance. How can you refine a system when your behavior is inconsistent? Execution quality is alignment. Your rules, your signals, your beliefs, all pointing in the same direction. When one is out of sync, the entire structure collapses. For me, that meant waiting for objective confirmation rather than emotional encouragement. I'd rather miss a move than force a low-quality trade. Missing costs nothing. A bad trade costs capital and confidence. Confidence grows from repeated disciplined actions. Each time you follow your plan, even if the trade loses, you reinforce the beliefs that support successful trading. That kind of psychological compounding doesn't appear on charts, but it determines everything. Execution isn't glamorous. It's steady, structured, sometimes almost dull. You place stops before entering. You define targets and boundaries, and then you follow through without interference. You don't move your stop out of fear. You don't exit early out of uncertainty. Execution quality means trusting your process more than your momentary emotions. You know what separates professionals from amateurs? Not intelligence, not information. It's consistency of behavior. A professional can lose several trades and remain unaffected because the behavior never changes. Amateurs rewrite their rules every time discomfort appears. They interpret losses as personal failure instead of statistical inevitability. When you focus on execution instead of outcome, you stop counting wins and start evaluating discipline. You begin asking, Did I trade my edge instead of did I make money? Because when you execute with clarity, money eventually follows. There were stretches when I placed no trades for days. Some would call it hesitation, but I called it alignment. I waited until the environment matched my rules, until everything resonated with my framework. And when I finally acted, it felt effortless. That's what proper execution feels like. Centered, confident, almost uneventful. Trading too frequently dulls your awareness. It distracts you from subtle shifts. But when your focus is on execution quality, your mind sharpens. You start noticing things you used to overlook. Shifts in conviction, failed tests of support, hesitation candles. Those subtle variations in behavior become information rather than noise. They reveal when the collective belief is strengthening and when it's weakening. Those small details become your cues. They tell you when the psychological environment supports taking risks and when it doesn't. And here's something critical. High-quality execution protects your mental and financial capital simultaneously. Every sloppy entry or emotionally delayed exit erodes more than your account. It erodes your belief in your own process. But when you execute with precision, your risk stays contained. You manage the downside before you allow the upside to unfold. That's how professionals survive losing streaks. They don't fragment mentally. They don't bleed out from internal conflict. Execution also builds self-trust. When you know you can follow your rules, you eliminate the biggest internal threat to trading performance, self-doubt. You stop second-guessing, stop altering your rules on the fly, and begin operating with clarity. And clarity is rare in this business. Most traders drown in psychological noise because they combine ideas, strategies, and impulses without ever mastering the foundational principles that hold everything together. But once you master execution, the rest of your trading begins aligning naturally. When I started trading less often but executing with far greater precision, everything shifted. The market hadn't changed, the setups hadn't changed, I had. My structure was the same, my strategy was the same, but my focus shifted from how many trades can I take to how flawlessly can I execute the next one. And that shift changed everything about my interaction with the market. Because in the end, it's not about how often you act. It's about how well you act when the moment of opportunity appears. Every trade is a moment to demonstrate discipline, not ego. The market doesn't reward effort. It rewards alignment. Trade structure, not emotion. Because structure is stable and emotion is not. It took me years to truly understand that charts don't care how I feel. In the beginning, I traded from fear and excitement rather than from my framework. I felt uplifted when price moved in my favor and attacked when it moved against me. Every tick felt personal, as if the market was challenging or approving my decisions. But the truth is, the market doesn't even register your existence. It has no awareness of your hopes or fears. It moves according to the psychological forces of supply and demand, confidence and hesitation, accumulation and distribution. Once you begin trading from structure instead of emotion, your entire performance shifts. I used to stare at charts and see what I wanted to see. I'd interpret a tiny rally as a reversal or a sharp dip as a meaningless shakeout simply because I was positioned in a way that made me hope for that outcome. You ever done that? Seeing the chart through the lens of your fear or your desire? That's not analysis. That's bias masquerading as logic. I learned the hard way that the market punishes traders who project hope onto uncertainty. Hope isn't a strategy. It's a psychological trap. Structure is the antidote to that trap. Structure is objective. It reflects what is, not what you want it to be. Structure shows itself in trend behavior, key levels, volume dynamics, and how price behaves under pressure. Trade based on structure, and you align yourself with the market's underlying behavior. You follow the footprints of the participants who actually move the market, the ones whose actions create the patterns. They leave evidence in the chart. If you learn to see that evidence without emotional interference, you begin trading based on probabilities rather than impulses. You see, emotions distort timing. They make you chase late and exit early. Fear keeps you out of great trades. Greed keeps you in destructive ones. The moment emotion influences your decision-making, you disconnect from your edge. That's why I forced myself to see charts for what they displayed, not for what I emotionally preferred. The market doesn't reward feelings. It rewards clarity, consistency, and adherence to structure. Think about it like this. A pilot doesn't fly an aircraft based on how he feels that the sky might behave. He relies on instruments, structure, and training. If he starts reacting emotionally in turbulence, he loses orientation. Trading works exactly the same way. The chart is your instrument panel: trend, support, resistance, context. Volume is your navigation signal. Your job is to interpret that information clearly, even when your emotions resist it. When I committed to structure, patterns I had previously overlooked began jumping out at me. The tightening before expansion. The surge in volume when institutional conviction steps in. The way price quietly fails at resistance before snapping the other direction. These weren't coincidences. They were psychological fingerprints left by the market. And once I trusted that behavioral rhythm more than the voice of my fear, my trading stabilized. I stopped reacting to every fluctuation and started waiting for structural confirmation. Let me ask you something. How many times have you exited a trade out of fear only to watch it move exactly as your original analysis anticipated? That's emotion overpowering structure. Your logic recognized the setup, but your nerves overruled your logic. I did that countless times. I'd see the perfect breakout developing, but one minor pullback would trigger my anxiety, and I'd exit, just in time to watch the market explode upward without me. It wasn't the market that betrayed me. It was my emotional conditioning. Structure gives you something emotion can't: consistency. When you follow structure, you rely on known guidelines, not shifting impulses. You don't have to guess. You just observe and respond. That meant defining my levels: entry, stop, target, before the trade, and never changing them once the trade was active. Because the moment you adjust a stop out of fear or stretch a target out of greed, you abandon structure. And when you abandon structure, you abandon your edge. Emotion whispers, lies. Hold a little longer, it might bounce. Or, take profit now before it disappears. But structure speaks the truth. It tells you when a move is intact and when it's losing integrity. It signals through behavior, not feelings. The real key is learning to trust those behavioral signals more than your emotional reactions. When I trained myself to see structure, I spent hours studying historical charts. I'd trace patterns, mark turning points, and ask, what was the market communicating here? Over time, I saw how the same behavioral patterns repeated across all markets and timeframes. That's when I realized something profound. Structure is universal. Human psychology is the constant. Fear and greed never evolve. They just express themselves in different forms. Structure allows you to recognize them before they erupt on the screen. Trading with emotion feels exciting, but it's chaos disguised as thrill. Trading with structure feels calm, even boring sometimes. But that boredom is discipline disguised as mastery. And discipline is what pays. Every professional trader I've met said the same thing. Trading becomes far easier when you stop trying to feel smart and start trying to stay consistent. The goal isn't to be right, it's to be aligned. You ever notice how the best setups feel uncomfortable when it's time to pull the trigger? That's because they often demand acting before your emotions agree. Emotions encourage you to buy when it feels safe and sell when it feels dangerous. But structure tells you to buy when risk is minimized and sell when risk is elevated, which usually happens at moments when your emotions completely disagree. Learning to act according to structure instead of comfort is one of the hardest psychological transitions a trader will ever make. Once I internalized that, I stopped seeking certainty. I started seeking probabilities. Structure gave me the confidence to accept losses without emotional disruption. I knew that if I followed my process and acted based on clear signals, the probabilities would take care of the long-term results. Emotion may win momentary battles, but structure wins the long-term game. Every movement, every candle, every pullback, every spike tells a psychological story. The question is, are you reading the story, or are you subconsciously rewriting it to fit your biases? That's the trap. Most traders don't lose because they lack analytical skill. They lose because they can't see clearly. The market reveals the truth long before your opinions do. I learned this by watching the tape relentlessly, staring at charts until their rhythm became familiar. Here's the difference. Opinions are easy. They come from news, analysts, rumors, conversations. But price doesn't speak in sentences. It speaks through behavior and flow. The tape is honest. It reveals what participants are actually doing, not what they claim to be doing. That's the difference between noise and truth. When I was still relying on tips, I'd chase every rumor that promised a fast move. Someone would sound confident, and I'd buy based on that conviction. But the chart disagreed. There was no supporting structure, no real participation. Volume was weak, momentum lacked conviction, and I'd hold on just because someone sounded authoritative. You ever trust someone else's opinion more than your own observation? Every time I did, I paid for it. Because the market doesn't respond to promises, it responds to behavior. Behavior shows up in price. Price is the cleanest representation of reality. No delays, no filters, no narratives. Just pure supply and demand. That's why I stopped consuming endless reports and started consuming price action. Because by the time an opinion becomes widely accepted, the move is already well underway. Price reveals the shift before headlines do. I used to think I needed to understand every economic release, every press conference, every analyst projection. But eventually, I realized something profound. All of that is already embedded in the collective behavior of price. The market's largest participants act early. Their footprints appear long before the news does. You see it in early accumulation, in the quiet basing patterns, in the subtle volume increases. If you learn to recognize those clues, you start seeing truth unfolding while everyone else waits for confirmation. Let me ask you something. How many times have you watched price fall after positive news or rise before big announcements? That's price exposing the limits of opinions. The crowd chases stories. Professionals follow behavior. When you align with price, you align with the only opinion that actually matters, the one backed by real money. I remember a trade long ago where everyone was wildly bullish. The headlines were glowing. Sentiment was euphoric. I Watched price climb, but something didn't fit. The volume wasn't supportive. The rallies lacked conviction, and the tape felt soft. The price went up, but the structure was brittle. I stayed out. Days later, the entire thing collapsed. That experience embedded a truth I never forgot. Opinions may sound convincing, but price reveals reality. Price action is a mirror reflecting the true balance of belief. If demand outweighs supply, price rises. If supply outweighs demand, price falls. It's that simple. And yet most traders complicate the simplicity by injecting emotion, personal bias, and external noise. They end up trading their internal narratives instead of the actual behavior unfolding on the chart. They trade beliefs instead of information. The only belief worth having in trading is that price reflects more knowledge than you, more information than you, and more conviction than you. You can sense it in the movement when something begins to shift. The market starts communicating differently. Momentum softens, volatility expands, candles stretch wider, volume pulses irregularly. That is the early whisper of changing collective belief. You don't need to understand the cause yet. You only need to recognize the effect. The explanation comes later, after price has already expressed the truth. That's why the most consistently successful traders trust price behavior above all else. When you start paying attention to raw movement, you begin noticing how price behaves at key levels. Support isn't just a line. It's a zone where buyers reveal conviction. Resistance isn't just a line. It's an area where sellers express hesitation or fear. These reactions are direct expressions of the crowd's beliefs, revealed through their actual behavior, not through their opinions. And that's the point. Trading is about interpreting behavior, not validating beliefs. Markets are driven by universal human emotions: fear, greed, uncertainty, and those emotions manifest visibly in the chart. When fear overwhelms, candles plunge violently. When greed dominates, rallies extend irrationally far. Price doesn't explain itself. Price simply expresses itself. Your job is to interpret that expression without distortion. You ever watch a breakout that looks ideal at first glance but feels inconsistent? Maybe the volume doesn't support it. Maybe price hesitates right after clearing the level. That hesitation is truth revealing itself. The crowd sees opportunity, but the behavior shows fragility. Those moments taught me to trust the market's message more than my emotional expectations. The beauty of price action is that it removes guesswork, if you allow it to. You don't need to predict. You don't need to rationalize. You just need to observe. The market gives you signals every day: trend direction, momentum, strength, exhaustion. Your job is to read them, not reinterpret them through fear or desire. When I talk about truth in price, I mean it, literally. The market communicates its collective beliefs constantly. Every large participant leaves footprints. Every shift in sentiment expresses itself through behavior. If a stock can't hold gains despite positive news, that's truth. If it won't drop even on negative headlines, that's truth too. Opinions dissolve quickly. Price persists. Once I accepted that, my trading simplified. I stopped asking, "What does everyone think?" and started asking, "What is price communicating right now?" That one shift changed everything, because price is impartial. Price doesn't flatter, comfort, or justify. It simply reflects reality. When you align yourself with that reality, you stop being surprised by market moves. You can feel when the tape tightens, when accumulation begins, when distribution takes over. These are the subtle forces shaping the next trend, and they always appear before the news aligns with them. That's the edge you gain by trusting behavior instead of narrative. Most traders fail because they seek validation from others. They want confirmation before committing. But by the time consensus forms, the opportunity has already passed. The crowd trades comfort. Professionals trade behavior. And price, my friend, does not wait for comfort. It reveals the truth long before the majority is prepared to accept it. Consistency builds wealth. Impulse destroys it. Those 6 words contain more trading wisdom than entire shelves of technical books. When I first entered the markets, I thought success came from brilliance, from catching the perfect move or making the perfect prediction. But with time, something became clear. Fortunes weren't built from brilliance. They were built from consistency. The traders who endured, the ones who accumulated real wealth, weren't the flashiest or the loudest. They were the ones who executed the right behaviors repeatedly, regardless of emotion or circumstance. In the beginning, I bounced from one idea to the next, chasing excitement instead of mastery. One day I traded breakouts, the next I bought dips, then scalped volatility, then switched to swing trading. I called it adaptability, but it was really inconsistency, disguised as flexibility. You ever do that? Changing strategies the moment discomfort shows up? That's how traders stay stuck. They never allow one method to reveal its long-term probabilities because they're too emotionally impatient to stick with it. Consistency isn't glamorous. It doesn't give you a thrill. But its stability is exactly what makes it powerful. It's predictable. It's controlled. It's repeatable. Every consistently profitable trader I've known treated trading as a long-term business, not a short-term gamble. You don't overhaul a business model every week because one day's sales were bad. You refine gradually, based on evidence, not emotion. That's what consistency truly means, acting from structure, not impulse. Impulsive trading is the opposite. It's reactive. It comes from fear, greed, boredom, revenge. You see a sudden move and feel left behind. You jump in without a plan. Sometimes it works by accident, reinforcing the illusion that randomness is skill, but it never lasts. Impulse has no foundation. It's like building a structure on sand. The moment the environment shifts, everything collapses. When I finally understood this, I stopped asking, how much can I make this week? And started asking, how well can I follow my plan this week? That's when everything stabilized. The profits came slower at first, but they stayed. Losses became smaller and more controlled. I wasn't chasing the big win anymore. I was building a framework that could support a lifetime of trading. Let me ask you something. Would you rather make a fast 1,000 today and lose 2,000 tomorrow? Or earn a steady 100 a day for months? Most traders claim they want consistency, but their actions reveal otherwise. They get restless in quiet markets. They force trades to feel active. They allow small errors to snowball into large losses. Wealth isn't built from excitement. It's built from repetition. Consistency means showing up every day with the same mental structure, the same preparation, and the same respect for risk.